Guys on Wall Street that, well, this time the Fed's cutting rates because it's just precautionary. The housing market's fine, and subprime is contained. It's just like, like an insurance. It's an insurance policy. We're cutting rates by 50 basis points just in case something happens. That's what I heard in 2007 too. So let me give you quickly 3 things that are very, very different this time. I'm not saying the market's falling apart right now. It isn't. I run money for a living, and my portfolio is doing well, thank God. And I'm not short right now.
In today's episode, Michael Pento, founder of Pento Portfolio Strategies, emphasizes the importance of gold and silver as safe haven assets in a climate he describes as rife with economic instability. According to Pento, the traditional 60-40 stock bond portfolio approach may not withstand the impending economic pressures, as he foresees severe stagflation and a recession that could deeply impact the U.S. economy. In his view, gold and silver are positioned to provide much-needed security, offering a hedge against the anticipated decline in real interest rates and the potential for prolonged economic turmoil. As traditional assets face increased volatility, Pento believes these metals can offer a stable store of value. Pento argues that amid ongoing inflationary pressures, real interest rates are likely to remain negative for an extended period, even as the Federal Reserve struggles to navigate between inflation control and economic stability. He warns that despite recent rate cuts, the Fed's moves may only serve to heighten instability rather than stabilize it, citing past cases where rate reductions failed to prevent severe market downturns. The demand for gold and silver, he suggests, is driven by both the likelihood of higher inflation and the Fed's limited ability to protect real purchasing power through its policy tools. For Pento, this makes precious metals an essential component of any portfolio preparing for turbulent times. Additionally, Pento forecasts a broader economic fallout, including potential liquidity crises and declining real estate values, which he believes will hit investors and middle-class Americans particularly hard. This impending chaos, as he describes it, underscores his view that conventional investment strategies may be insufficient. Pento himself holds over 10% of his portfolio in gold and has recently increased his exposure to silver, anticipating what he calls a long-term breakout in these metals. As the U.S. faces unprecedented fiscal challenges, Pento advises that those seeking protection should consider gold and silver as foundational assets to weather the economic storm. Now we'll show you more clips, but first subscribe and turn on notifications so you do not miss out our daily recaps. Let's make America great again.
Yeah, I own over 10% of the portfolio in gold. I actually picked up silver about a month or 2 ago. I looked like it was primed for a massive long-term breakout, which is exactly what happened. So yeah, if you don't have precious metals, which aren't part of your 60-40 portfolio, right, you're going to be left behind. Because here's why I say that. Real interest rates are going to be negative for a very, very, very long time. They're not negative now, but they're going to be negative for a very, very, very long time. Years, if not decades. That's my thesis. Until we have a clash with hyperinflation. Which is, I mean, I'm not trying to scare people, I'm not using hyperbole, but, who would have ever told you when I first got in this business in early 1990s that one day our central bank would print trillions and trillions of dollars in the matter of a couple of years? They think you're completely moronic, because back then the Fed's balance sheet was like $100 billion. The entire balance sheet was nothing. So I would sound like a buffoon, like a Cassandra. But that's exactly what they have done. And they were doing it before COVID. Okay, so the Fed's balance sheet was $4.5 trillion. So it was a result of the global financial crisis. So his balance sheet could go to $20, $30 trillion. The national, you could have a national debt that has $60 trillion. in the next 10 years. We have multiple $1 trillion deficits every year for the next 10 years. At a minimum, you're going to have $2, $3 trillion deficits. That's without, God knows what Janet Yellen, I'm sorry, if Kamala Harris becomes president, if she has all these spending plans to give people, everybody gets a house, everybody gets, some money for a child, God knows what they could go. And that's saying the deficit is going to rise $20 to $25 trillion in the next decade if there's no recession and if there is no inflation. You want to bet me right now that there'll be one of those two things in the next 10 years? So that's what the gold market that's what the gold and silver market is sniffing out. It's bond market chaos more than anything, and real interest rates.
More news recap related to the topic that you should be on top of from Russia with love. Silver has not historically been associated with central banks. The relatively low price of silver versus gold means 70 to 80 times more silver than gold would have to be stored to attain value equivalency. Those who have been following the trend of Russia accumulating gold to diversify its foreign exchange reserves as it dumps U.S. treasuries will not be surprised to learn that Russia has announced plans to add silver to its reserves. The addition of silver to its already substantial holdings of gold, platinum, and palladium is outlined in the country's draft federal budget, which proposes an annual allocation of 51.5 billion rubles for precious metals purchases through 2027. John Stuart Little, an analyst at the Silver Academy, warns of the potential ripple effects, especially if other countries follow Russia's lead in building up their silver war chests. The ramifications of this shift extend beyond mere price movements. A significant revaluation of silver could disrupt existing financial paradigms, challenging the dominance of fiat currencies and potentially accelerating the transition towards a multipolar economic world order. The Silver Academy's report suggests that this move could be a game changer for the precious metals market. As the BRICS nations continue to explore alternatives to the dollar-centric financial system, including the possibility of a commodity-backed currency, silver's role could become even more pivotal, Little concludes. On the demand side, silver, like gold, is a precious metal that offers investors protection during times of economic and political uncertainty. However, much of silver's value is derived from its industrial demand. It's estimated around 60% of silver is utilized in industrial applications like solar and electronics, leaving only 40% for investing. A report by Oxford Economics commissioned by the Silver Institute found that demand for these sectors is forecast to increase by 42% between 2023 and 2033. The transition to an electrified economy doesn't happen without copper and silver, which is why, in my opinion, they are among the most highly investable commodities now and for the foreseeable future. The danger for end users and opportunity for resource investors of coming shortages for both metals only strengthens my thesis. In a recent commentary, the Silver Institute said industrial demand rose 11% last year to a new record of 654.4 million ounces, smashing the old record set in 2022. In fact, demand exceeded supply for the third year in a row. Now we'll show you more clips, but first smash the subscribe button and share this video with a stacker because more people need to be in the know. Let's get back into the episode.
Here's why I'm concerned. I'm concerned because the bond market, I wrote a book about this in 2013. I said someday the bond market is going to fall apart. And I didn't mean 100 years in the future. I didn't mean in 2014 either. I just said at some point the Fed is going to have a dilemma where they're going to have to, they're constantly providing low interest rates in real terms. You're going to create eventually inflation, and that's going to send the bond market higher. That's what I said. That's exactly what's happening. So you have illiquidity concerns, insolvency concerns, and inflation concerns, which are driving up bond yields, which is completely the opposite of what's supposed to happen and what the Fed wants to happen. No. No, we will never. I've given up all. Not that I had a lot to begin with, but I gave up any hope in the central bank to ever do the right thing. I mean, Powell tried. He feigned an interest in doing the right thing. Got rates to 5.25% to 5.5%. Looked good, but now he's panicking. And let me tell you the real reason why he's panicking. It isn't because the stock market's doing terrible. No, that's not true. It isn't because the money markets are frozen. They're functioning very well. Credit spreads are as tight as they could possibly be. It isn't because inflation is plummeting. That's not true. It isn't because the unemployment rate is spiking. It's not true. It's way below average. Powell panicked for one reason, because he doesn't want his friend Janet Yellen to pay $1 trillion+ a year on interest payments on the debt. That's it. I mean, he can't be honest and say that, but that's the real reason. He doesn't want Janet Yellen to have to pay 20% of all of our revenue on interest payments. Funny thing happened though, Jerome, when you cut interest rates and the bond vigilantes say, oh, Mr. Powell, you no longer care about inflation, or controlling inflation. Well, then we have to care a lot about it. And interest payments are going up across the yield curve, from two year all the way out to zeros, 30 years and longer. Interest rates are spiking. So our debt service payments in a collapse of housing prices and a collapse of the stock market, engendered by a freezing of the money markets, which is deflationary. Those things are extremely deflationary. If you can't float commercial paper, you can't make any short-term loans anymore. You can't borrow money short-term in the repo market. That is the most deflationary thing that you can ever have, because the economy doesn't function without the money market function.
What do you think of Pento's take? Do you agree with him? Post in the comments section down below your honest opinion, and share with the stackers if you think a major recession is coming in 2025 or not. Now watch this video right here because you'll love it, and I'll see you on the other side.